Good evening, everyone.
Good evening, Miguel.
Good evening.
Good evening.
What a beautiful view, right? What a beautiful day. Thank you for being here. If you're here today, you're a relative, you're a friend, you're a client, you're a strategic partner. So we thank you for being here today. My business partner here, David Castillo, our team right here. Raise your hands. Agents of Right West Collective. Thank you, thank you. Where's our host? I think he's out and about. We want to thank New Venture Escrow for hosting us here at this great venue. And our speakers today are going to be Jeff Bemis and Skyler Stokes. If you're here today, you're interested to learn more about how to sell your real estate investment or your property and deferring capital gains taxes without having to buy another property, which is even sexier, right? If you're exhausted, I presented earlier today, and I said we're like the Statue of Liberty. Give us you're tired, you're downtrodden, you're beaten. Those landlords that are just tired of dealing with bad tenants, et cetera, et cetera, et cetera. Or maybe you have a single family residence and you want to exchange it and buy a much bigger property that has more cash flow for you. So today you're going to learn a bunch of strategies to be able to do that and defer paying capital gains taxes. So we're going to get the party started with Jeff Bemis.
Today I'm going to talk about a little bit about our company, which is 1031 Specialists, and then the title of the presentation is the magic of 1031 exchanges. And this has been it's a huge opportunity for investors. It's a truly, we call it like the eighth wonder of the world that you're allowed to do this in the United States. It's been around for 100 years. And we'll talk about what is a 1031 exchange, what are the options in a 1031 exchange. It'll lead into what Skyler will do in his presentation, and then things and other opportunities for investors to consider along the way. So first, this is Jeff Bemis, this is me. I'm the founder and owner of 1031 Specialists. I started my career at Ernst & Young as a CPA. I worked in private equity for a period of time and then worked on the buy side at a hedge fund as a portfolio manager. And several years ago, I wanted to build something and create something. My father was a tax attorney. My brother's an estate planning attorney, and always been familiar with this space and these elements, and always felt I could build something inside of this community. And so we've done that. And so now we are a qualified intermediary, which is integral to 1031 exchanges, which I'll go into. These are two other people in our leadership team. Jonathan Hilly, he also is a founder with me. We started together, we've been longtime friends. And Megan DeStito, who has been doing 1031 exchanges for 25 years, joined as well on the processing side and helping us execute for all of our clients. So we'll go into what are the basics, do I qualify, swap until you drop, planning to win, a little about us, and then obviously Q&A we'll do separately. The goal is to get this done within 10 minutes, so I'll zip through.
Take as long as you like.
Okay, but goal is still to be done within 10 minutes for everybody's benefit. All right, so some of the basics. So who are the parties that are necessary for a 1031 exchange, and what are the related agreements and relationships that exist? So this is a bit of a diagram here breaking down how it works, right? In a basic 1031 exchange, what is that? You're swapping real estate. You own an investment property, you want to buy another investment property, or something that equates to an investment property like a DST interest, but effectively swapping real estate, right? So you have an investor and a QI, okay? Investor sells the property. As mandated by the IRS, they cannot take constructive receipt of the funds. So you need to hire someone like 1031 Specialists to be your qualified intermediary. That cannot be an advisor. It's basically, a qualified intermediary is someone who is not disqualified, and that includes your accountant, your broker, your lawyer, and any other advisors you have. So you would hire us. When you sell your property, the money from that sale will come to us. We hold all the money in segregated trust accounts. None of the money moves without your authorization, but you cannot access it as part of the transaction. It is sitting with us. You identify the new property, which we'll go into. You buy the new property, the replacement property. QI then releases the funds for the purchase, and you're done. Okay, so you've sold the property, money comes to us, we hold it and segregated trust accounts, which are sort of the industry standard for best practices. And then you buy the next property and you're on your way. So there's several type of exchanges you can do. The most vanilla, and I would say for most people, over 90% of exchanges are what's called a forward exchange. And that is, I sell my property and then I buy the next property, okay? And so when I sell the property, there's timelines that are related to this. So when I sell my property, you then have 45 days to identify your replacement property. Again, this is all vis-a-vis the IRS rules, right? And why are we doing this? Because if we have a property worth $1 million and it has a $200,000 basis and there's $800,000 of built-in gain and probably some depreciation recapture and maybe other taxes you need to consider, all of that will get deferred as long as we buy a replacement property using these steps. So you have 45 days to identify replacement properties. In general, people use the two main ways to identify. You can either do 3 properties, which is the primary way folks do it. So you have 45 days and you can change that all you want in that first 45 days. Once that's identified at the end of 45 days, you're locked in. And Skyler will go into more of how considerations you can do on what you put into your bucket. You also can identify up to 200% of the value of your relinquished property as your replacement properties instead, which can be over 3 properties. But in a forward exchange, you sell, you identify, you buy. In reverse, you can go buy the property that's your replacement property first if you want. Obviously, we can talk about the capital dynamics and constraints there. I'm happy to go into that in Q&A or other discussions. But you need to go buy the property. It's usually better for cash buyers. And then you have 180 days to go sell your property. So it sort of works in reverse. And so then you've bought the property, you're holding the property that you want to buy, and then the one that you're owning and relinquishing, you have 180 days to go sell that. And then you sort of collapse the whole structure and effectively pay yourself back for the purchase property that you did with the proceeds you did on the sale. And again, we can go in, I'm sort of paraphrasing it, and then there's an improvement exchange, which is, it can be forward or reverse, but if you want to make improvements to a property and you want to do it inside of the 180-day window, you can buy a property and use exchange proceeds to actually improve the property you bought and have that be a part of the exchange. And so that gets used from time to time. One thing that's surprising to me is that folks don't realize just the breadth of which a 1031 exchange can be utilized for. I mean, we have 16 different property types here that we've identified, and it runs the gambit. And so what are some examples of things that people are doing that is really common? People hold land positions, right? And they want to get some yield. They've inherited a duplex that they have to self-manage or don't want professional management and want to get into a more diversified portfolio that's professionally managed. You can also go into mineral rights, right? You can go into Delaware statutory trust units. You can do VRBO, Airbnb. Really, you can do pretty much anything on the investment property side. And so this is, I would say, surprisingly not well known, that the flexibility, also geographies inside of the United States. So I want to be more in the South. I don't want to be in a California urban area. I want to have a strip center in Alabama. And these are all sort of tactical decisions that our clients are making and doing so effectively. So truly you can do anything as long as it's an investment property, one for the other. Do I qualify? Okay, and so there are some things to note here where you don't qualify for a 1031 exchange, okay? The three tests. Who are you, what do you own, and when did you buy it, okay? On the third one, it's a little bit of I'll give a caveat. Number one, are you a flipper or a developer? This is meant to be for someone who owns investment property swapping to another investment property. If you are a flipper, so you have your entire business is flipping and you're doing lots of volume, that fact pattern is not intended for a 1031 exchange. Neither is ground up development. Obviously, I told you about improvement exchanges, so there is some improvements that you can make inside of this. It's what you own, so it needs to be real estate held for business or investment purposes, effectively an investment property, and when you bought it. The rule of thumb generally that people talk about is that if I owned it for over 1 year, that shows that this is an investment property with an intent to be an investment property. But just so you know, we've been working with clients who don't have a 1-year hold period, which is, I'll call it the common wisdom. And as long as the intent is for it to be investment property, there is no rules and or IRS supplemental guidance that says that it needs to be greater than a year. That is just not true. And so if it was intent to be an investment property, it's perfectly legitimate. Obviously, we'll want to have the facts together to support that position to the extent that it ever gets get an inquiry. So we just sort of compare what I just mentioned there between investor, flipper, developer. What are the dynamics that sort of define those groups, right? Investor is someone who's intending for the long term. It's held for investment. If it's greater than 1 year, you're definitely in the clear. But like I said, it doesn't necessarily have to be the case. And it's investment. Rental or lease income as the byproduct is a good fact pattern. But again, it doesn't have to be that. It's a facts and circumstances situation. And then here's sort of a dynamic for flippers and developers, sort of things like I just touched on. But yeah, if you're in the business of turning real estate, that's not as good a fact pattern. Again, appreciate that there's lots of elements of gray inside of this, of course. And we can talk about any of that if you like. So sort of swap till you drop. The beauty of 1031 exchanges is that you can do it ongoing forever. Like there's no limit to how many you can do. There's family offices in the San Diego, Orange County area that have been doing this forever. I mean, they must have no basis in any property they have, and they just keep rolling it. And, just rotating periodically. And if you're doing passive interests, like you can also own a tenant in common interest as an example, much like a DST interest. And those will sell periodically, and lots of those investors will roll from that professionally managed property into the next one and just keep going. It's very powerful, right? The compounding elements are powerful. So we show an example here of what happens if you exchange versus not exchange in an example property where you have $500,000 of equity and you pay the capital gains tax or you don't pay the capital gains tax. And we just show here a quick example that in this particular example where you have a 20% down payment, $500,000 in equity, and an acquisition value of $2.5 million, you're going to have a $325,000 difference in that particular example. Just quick math on it. Here, while this is not particularly realistic in a short time frame, we show how these compounding elements multiply through time. That if you're 1031ing versus paying tax each time at a marginal tax rate of 30%, which assumes you may have some state tax, et cetera. If you had a 50% gain on your equity each time, which we can debate the merits of this, and you did this 20 times, the point of this is that you'd be at $332 million in the compounding tax-free and $40 million if you didn't do a 1031 exchange. So it just shows why so many family offices and so many folks who are using this tool. So what happens as the end game when you pass away, right? And that's a bit of the other magic in this. While it is going to be subject to estate tax limitations, when you pass away, your family gets a step up in basis, okay? And so you've been deferring tax. You've likely been taking depreciation on these properties, depending on how you structured it. You've been getting lots of benefits to your personal tax position, plus plus compounding tax-free with any 1031 exchanges you're doing. Then it's okay, well, at some point we're going to have to pay the piper because when we sell this property, it's got no basis. And if I sell for $1 million, the entire gain will be recognized on all $1 million of the property value. But no, if you pass away, your heirs inherit the property. They then can step up the basis to then market value. And if your husband and wife is $26 million of portfolio value, that will avoid state tax. And you end up with the step up and no estate tax. And so, we could say swap till you drop. And you end up creating so much wealth for the family inside of this that it's extremely powerful and something that no other product offers other than real estate. So something I'd mention about our business as being a qualified intermediary, it's all about planning, okay? And, the things that people get concerned about 1031s is it feels like I have a gun to my head as far as the timelines are concerned. And if I'm a 1031 buyer, I'm gonna have to overpay because everybody finds out that I'm a 1031 buyer, and I'm gonna have to overpay. And when they find out, they're gonna hold me hostage. Planning is everything, and I would say as a general matter, and it's not, there are exceptions, if you plan ahead, the timelines generally are not a prohibitive issue, okay? So, number one, you have the 45, once you sell your property, you have 45 days to identify, as we talked about, which is the biggest constraint, truthfully, of the process. But that's when you've transferred the property, right? If you get the property locked up, you understand who your buyer is, and you create a delayed closing, or you do an option framework, or other type of structured piece, as long as you haven't transferred the property, you are extending your timeline for the 45 days. So these are things to consider. And then on 1031s, cause you to overpay for properties, no one has to know. It really only has to be disclosed at the very end that you're doing a 1031 exchange as you're doing the closing documents. So this is the timelines we talked about. You have the 45 days to identify, of which you'll have your qualified intermediary, right? You've sold your property, the proceeds have come to us, and then we are the ones who receive your identification. So we have forms and paperwork we have you fill out that say, hey, here's the specific properties. And the IRS, unfortunately, requires a very specific answer to what you're buying. You can't just say, hey, I'm going to buy multifamily in LA. It doesn't work. So you have to have specific addresses, specific properties. And Skyler can talk about some of the opportunities inside of that with alternative products. We see a lot of clients use them, and just as a sidebar about what Skyler's involved with, they're really great tools and helping clients out a lot. So, and then you have the 180 days. So, and just so you know, these day counts, weekends and holidays, if it's on a holiday, too bad. That you still have to close by that day. So, I would just say as one plug for 1031 specialists, if you call, you're gonna get me, John, or Megan. Like, that's what you're gonna get, right? And so we are always available. And there's war stories that we hear along the way, and part of why we started this business was that we knew we could be better. So you have to, 45 days is just 45 days. It's not business days. Same with 180. So what's some things you can do to plan to win, okay? It's, there's no excuse for not having enough time and for the 45-day clock, which I said is the bigger constraint of the two. If you're working with a broker, let's shortlist more properties that will fit the bill. As a 1031 buyer, you need to be more open-minded about what can work. Getting married to one singular property or particular investment is likely a mistake. There's all kinds of reasons that things don't close, which this community, I'm sure, is well aware of. And so you need to have options. Identify the replacement properties. Use tools to extend your timelines if you are concerned that it's not going to happen on time, right? And we're sort of talking about forward exchanges, reverse exchanges are different, right, where you buy the property first. And then, you can put your target properties under contract, or you can do a reverse exchange, as we just mentioned. This is we're on Twitter, we're Mr. 1031. And I don't have my shirt on, that's a Mr. 1031 shirt. So Mr. 1031 is us. That's a picture of my partner, John, in case you're wondering. You can follow us, we put out a lot of content. And you say 1031 exchanges are hard, and he got a reply saying, well, if you're saving that kind of tax savings, it's not necessary, it shouldn't be easy. We leave this slide blank because our main thing is don't tell anybody, right? Why, it's like, oh, I've got my 1031 buyer, I've got him over the barrel, and it's, the only thing that really happens is at the very end with escrow, there's a notice that has to come out to a notice of the assignment because the QY is going to be on the closing statement and take effectively title, right? Like we don't we can just do it as a clean transfer. It doesn't actually have two separate transfers, but we do have to notify the buyer as part of the process that this is a 1031 exchange related purchase, but that's at the very end, okay? And so there's no reason to tell anybody. We always recommend don't tell anybody, and we always get a lot of feedback that that is a very smart tactic to use, and generally I think brokers use it effectively. And I will say there are horror stories of people getting up against the timelines who have really early notice on it. So if you can avoid it, you can. I don't know that it necessarily means it's going to be a problem, but it just helps you. There's no reason to tell anybody. So our simple advice is plan ahead, have a process to identify properties as you're going in. And ultimately, we always say, like, in the end, if this doesn't work out, just so you guys know, you just pay the capital gains tax. It's not like there's penalties or anything else. You want to do a 1031 exchange. If in the end it's not the right business decision, you don't need to go get into something that's not a right fit. If it's not there, ultimately, don't let the tax tail wag the dog. And then there's other options too, and Skyler probably has some good suggestions as well about opportunities to minimize that tax burden with certain kinds of properties that you might get some accelerated appreciation on. So things that we have that we highlight to everybody is, you can go to our website, which is 1031specialist.com. So we've built what we think is the best calculator. We were looking around and just sort of identifying what people have. We built a calculator for everybody to calculate their tax and their circumstances. You can fill out all your different set of circumstances and facts around your relinquishment or your replacement. If you have any questions, we built what we call the 1031 Bible. It's an easy to read, but has lots and lots of information around more detail than this presentation. If you have questions on a specific exchange, our business model is to help people on the front end consultatively, and it's free. Like we're here to help clients, and our goal is, when folks, if they need advice or help, they'll remember that when we later on. So we're open to any and all conversations of people who just have a question about what they're trying to accomplish, and get started. One thing that I didn't mention, that is worth making mention in the on your replacement property, when you sell your own property, you have to have the same amount of debt on the replacement property as you did on the relinquished property, and you need to reinvest all the equity proceeds at least into the replacement property. You can always add money in, but just something of note that's popping into my head as we go through this. So this is a final thing about us, who we are, and why we're talking to folks like you, and think we can be a great solution for anyone you might have in your network. Is my partner was a Goldman Sachs investment banker, and he and I have been friends for a decade. I worked at Ernst & Young, and our goal is to build a really tech-embraced, forward-thinking, qualified intermediary that is super client first. We know you'll hire us, if you do hire us, it's because you'll trust us and like us, and we say in that order. So it's all about trust. If you want to know anything about how it's going to go, we're really upfront about what's the process, what we're going to do, how we're going to do it, how you can see your money, anything you want to know. it's complete transparency. Like I said, consultative client first approach. And then we say, and we're uniquely this way, but if you go into a 1031 exchange and you don't do the replacement property, we'll give you your money back because you didn't even do a 1031 exchange. So that's sort of our approach there. Support the client goals. Never forget rule 1. Support the client goals. While we are in Denver and in Orange County, we do exchanges across the United States. People are doing exchanges in all geographies. That's a very common thing that's happening is, they're in California with land and they want to go into a cool multifamily deal in suburban South Carolina. Things like, stuff like that's happening a lot. Here's how the pricing works. So reverse exchanges, we actually have to set up a separate LLC to purchase the property, and we can go into the details around how reverse exchanges work, but it's more complicated and more cumbersome in a major way and as specific liability for the QI. but we do them all. Standard exchange, it's $11.95. Here's a little about our background. If you want, I'll share this with everybody too, so they can have it. Our website has all this information and all the things I described. And let's see, that's it. So I'll leave the FAQs there, and I'll hand it over to Skyler. And then maybe at the end, if you have any questions around our role as the QI or anything else you want to ask, I'd be glad to answer any of it. Thank you.
Hey everybody. Hi there. Hello. Thanks for coming. My name's Skyler Stokes. I'm not a CPA, and I'm not an investment banker or super smart guy like Jeff is. But I'm really excited to go through this with you guys today. In this market, it's really hard to find replacement properties, especially when you're under the gun of the 45-day ID period. So for qualified investors or investors who have accreditation where they have a minimum net worth and or meet certain income requirements, they can use what's called a Delaware statutory trust to satisfy their exchange requirements and effectively defer all the capital gains. So that's what I'm going to be talking about today. Of course, with all investments, especially under FINRA and SEC guidelines, there are rules and restrictions. There are disclosures and risks associated with everything. So this is just a piece of what we normally have to give out to everybody. And then, of course, there's a 1031 risk disclosure. In our case, we can't ever guarantee any returns. We can't guarantee principal safety. We're not at the we're not a government agency. We don't, we're not a bond or anything like that. So, of course, with everything as far as real estate's concerned, there's going to be some risks associated with it. A little bit about me. I've been in this industry for about 15 years. I've been in public service as a lifeguard in Solana Beach for about 20. And I moved to Kauai. I was lifeguarding out there for a while and decided I needed to come home and actually not live paycheck to paycheck. So I started Aloha Wealth Partners after a while, feeling like I needed to do something different than what the typical Wall Street firms represented. So I started Aloha Wealth Partners as an ode to the time that I spent in Hawaii to kind of have that feeling for clients when they step off the plane, they get that fresh breeze of plumeria, and the shoulders go back and they feel like I made it. That's the kind of vibe that I want clients to feel. So Justin's over here with me. He's one of our associates. And then we have another associate, Derek, who just joined us too. So like I explained, Delaware statutory trusts are effectively just a trust that holds real estate assets. It could be any type of real estate asset, right? It could be a multifamily property. It could be a retail property. It could be raw land, oil and gas mineral rights. It can be whatever you can dream up, just like Jeff was saying. And currently, under Revenue Ruling 2004-86, they qualify as IRS like-kind replacement properties for people who are doing 1031 exchanges. So these properties are managed by a third party, and they have a fiduciary obligation to do what's in the best interest of the clients. And so these investors who have 1031 exchange funds, they can utilize a DST effectively through the 1031 exchange process and have it be 100% managed by somebody else who is a professional manager. So investors have a fractionalized ownership of this trust, right? So let's say as an example, you have $1 million property that you're selling and it's all equity and you're trying to find something that you can replace. If you want to get into something like a DST that has a $100 million property, let's say it's it's a 350 unit apartment complex in Texas, you effectively have 1% ownership of this $1 million property, right? It's really simple. So any of the cash flow that's collected from the rents gets passed through to you pro rata from your share of whatever rent's collected. Typically, there's only 499 investors that can be allowed in a DST at one time, so it kind of like narrows the gap as far as amount of people that can be involved in that particular deal. But once the property's sold, all the appreciation is then passed through to the investors. And at that point, they can either do another 1031 exchange when the property sells. They can take the capital gain, or they can do a combination of those things. So it just depends on what's happening at the time. The sponsor may have a disposition fee at the end, which is basically selling commissions to get rid of the property and list it and go through that process. But other than that, all the cash flow, all the appreciation gets passed through to the investors. So one of the benefits about, or 5 benefits about the DSTs is that number one, it reduces time constraints, right? These properties there's about 90 right now that are in the marketplace all around the country. And what you can effectively do is if you're in that 45-day window and you can't find a replacement property, you can utilize one of these properties for your replacements on your exchange paperwork. So it makes it really easy from an identifiable standpoint. You're not having to deal with feeling like you are going to have to pay the capital gain. You can use a DST at least as a backup or some sort of insurance policy in case you can't find something yourself. The second thing is this is institutional grade real estate, right? This is high quality Class A commercial or residential properties that are 2020, 2023 builds, really, really nice buildings. So it's not like the property in the corner that you may drive by and you see and you may that looks interesting. This is like multi-billion dollar institutional grade real estate. The third thing is, like Jeff was mentioning, there are a lot of things that we find clients are tired of, right? It's the tenants, it's the toilets, it's the trash, it's the termites, it's the terrible teas. So in this case, the DST sponsors, they're the ones who are managing the property on your behalf, so you have no responsibility. It comes off of your hands. It's all done by institutional grade real estate companies that are doing this on your behalf, right? So that's one of the benefits of getting into the DST is you're totally passive. So all the income's passive, all the management's passive, it just makes it really easy. If you're trying to replace debt, or if you want to add debt to your property, you can acquire a DST interest and the debt is non-recourse, meaning you're not personally liable for it. The way that this works is the DST sponsor will go out to find a property, they'll acquire it, and they'll put financing on it. And if you can imagine, if you as an investor have say a 20% loan to value, if you're going to try and apply for a loan and get approval, it's going to take a long time for you to get into this deal, right? So what they say is we're going to blanket this trust, we're going to blanket this deal with one loan, and you're going to assume it. So you can assume that debt, and it's non-recourse, meaning you're not personally liable for it. So it makes it really easy from a debt perspective or a debt replacement perspective. The fifth thing is there's diversification. You can get, the minimum is typically $100,000 in DSTs. So if you have $1 million property, you could effectively do 4 different deals or 10 different deals if you wanted based off of the 200% rule. And you can get into all these different types of product types, right? You could go self-storage or multifamily or oil and gas, mineral rights, or retail. It's mix and match, right? And we have a list of different deals that you can pick from and go into. So it makes it really easy from a diversification standpoint. So you get all these benefits, right? It's easily identifiable from a 1031 exchange perspective, access to world-class real estate, it's totally passive, you're fine. Non-recourse debt, and then diversification opportunities. So our role is to help clients in understanding what's available, what deals are good, what deals are bad, or which ones we would steer clients away from. And our expertise is just kind of guiding them in the direction that makes the most sense for their goals and what they're trying to achieve with a particular exchange. Some clients are like, I just want cash flow. I don't really care about appreciation. I just want my coupon. I want to clip it every month. I want mailbox money. Great, there's probably something for that. Other clients are like, you know what? I have a long time to go. I want as much appreciation as possible. So I'm okay to have maybe less income, but more appreciation potential. So that's another thing that we could do too. So we can kind of mix and match, like I said. So that's kind of our role. The limitations on DSTs, there's 3 of them. The 3 main ones are liquidity. Most clients, when they get into DSTs, need to understand that it's not something like a stock. There's no secondary markets for these interests, meaning you can't go online and say, I'm going to sell my shares of this DST and buy something else or exchange into something else. These are properties that are managed by a third party, and because of that reason, you're kind of in the deal with everybody else until they sell the deal. I'm not going to say that there haven't been instances in which that exceptions can be made, because there can be, but we just like to say just expect not to be able to access the cash or the capital while the DST is running. The time frames for these DSTs are typically 5 to 7 years. So it can be sooner though, and it can be later. It just depends on what the market cycle is. Because like I said before, the sponsors have a fiduciary obligation to the investors. And so if they think that the market is better to hold on to the property for the moment and continue to get the cash flow like we're in right now, as interest rates are kind of bouncing around, people are trying to figure out what they want to do, sponsors are holding on to their deals because the cash flow is good. So once things kind of turn around and maybe the appreciation goes back up, now it's a good time to sell. So it just depends on what the market cycle is. I've seen DSTs that have gone within 2 years, and I've seen DSTs that have gone within 7 or 8 years. Just depends on what the market is. And then passive ownership, like I said, some clients actually like managing their property, if you can believe it. They like going and painting walls. They like doing the new flooring and all the projects that come with actually being a real estate owner and investor. And that's totally great. But it's not something where you can call a sponsor and say, I want to put a new lick of paint on this property, right? It's like it's all done for them. So that's something that you have to take into consideration. If you're a hands-on type of investor, DSTs are probably not in your wheelhouse. Now, in the ruling of 2004-86, DSTs have 7 things that you can't do in them. Otherwise, you're going to disqualify the product or the property in the trust, thus making it not eligible for continued exchanges. You can't take financing on it, so you can't do a refinance, because if you can imagine, let's say there's 400 investors are in this one deal. If you refinance the property, then everybody who is in that deal now has to take a new loan or is assuming a new loan. That might not be in the best interest of the clients, and so they say you can't do that. So it has to stay the same. Like there's no what was it? You cannot obtain new financing. You can't exchange another property, or you can't exchange this property for another property in the DST. It has to stay the same property. You can't call for capital. So the sponsor can't say, Tim or Miguel, unfortunately the roof collapsed. We're going to have to ask you for 50 grand. Can you please send it to us? Once the property and the DST is closed, then no more equity can be raised. What they do is, instead of doing that, they have a reserve account, like a cash account they hold as like a rainy day fund. And if they need to pull from that for repairs or other sorts of instances, then they can do that. They cannot renegotiate new lease terms or enter new leases. And then you can't make structural repairs. So you can't you can do minor improvements like new lighting or paint walls or something like that, but you can't build a wall and make structural repairs to the actual property itself. And then the last thing is you can't invest any of that cash that they hold on the side. They can't invest in anything other than short-term government securities because they want to make it safe. So let's do a little case study. Bill and Shelley, they're owners of real estate. They're in their mid-70s. They have 3 girls. They live in other states. But Bill and Shelley are tired of owning and doing all the renovation projects themselves. They want to enjoy their lives and have fun, and they're exploring DSTs rather than having to do their own property management and exchange into something else they're going to do themselves. So they bought this property back in 2002 for $600,000. It's a 5-unit building. They did a ton of work on it. They added value, kept rents up, and they're thinking they're probably going to get about $2.2 million for it. They have a debt of about $500,000, and they're trying to figure out, should they pay the tax, should they exchange, or maybe do a little bit of both. So in this case, what we did is we created a sample portfolio to show the clients, here's what the deals that we think would make sense for your situation are. These deals are in different markets, they're different sponsors, and we basically allocated the investment equity equally between all the different properties. And you can see right here, there's a non-recourse debt piece of it that we added up to make sure that we can get that purchase price of $2.2 million, just like we talked about. So the loan to value, like I said, you can pick and choose. Some DSTs have no loans, some DSTs do have loans. It just depends on what you want. Again, it's a menu you get to pick from. So in this case, they picked 2 properties without debt, 2 properties with debt. So they have 3 multifamily properties and then 1 self-storage deal. So from a diversification standpoint, they have 4 different companies that are managing about $400,000 a piece, right, of equity. And by asset class, they've got 75% of it's in multifamily, so residential. Everyone needs a home to live in, and these markets and these properties in these markets are not like tertiary areas or places out in the boonies. These are in metropolitan areas where people are moving to. They have due diligence packets like this thick just to educate on why they think it's a good deal. Here's the metrics behind it. So they're very sophisticated in the way they approach investing and buying a particular property. So multifamily and then self-storage. Here's a kind of some sponsor profiles. Diversification in 4 different states. So Phoenix, Denver, South Carolina, and Charleston, and then in St. Petersburg, Florida. St. Petersburg, Florida. So we were able to diversify them into 4 different states, 4 different markets, which was great from a diversification standpoint because you're not subject in one property in one market, right? It just makes it really easy. And here's kind of like a little piece of it. Again, these are really nice quality properties. These aren't old shabby buildings. This is a 2022 build. It was during lease up that they bought this property, and now I think it's at like 90% occupancy, 248 units. Really nice appliances, and they're great. Clients can actually tour these properties if they'd like. So there's actually a deal right now in Temecula. It's a semiconductor property. It's like, I don't know, some 100,000 square foot property. But it's like it's a $150 million building, basically. And so clients, if they want to go take a look at it, they can walk through the property with the sponsor, and we can do that together. It's pretty cool. There's one in our backyard down here on 4th and J. It's a multifamily building. It's like 168 units, but these properties aren't. You'll drive by them and not know that they're a DST. Here's another one in Florida. This is a self-storage portfolio. Self-storage is the best performing real estate asset class for the last 20, 25, and 30 years. It's outperformed all different other asset classes. So as far as like an appreciation perspective, this is something that they wanted in their portfolio. Brand new buildings. This is a really unique property. This is in Phoenix, Arizona. Have you heard of Taiwan Semiconductor Manufacturing Company? So that company has a master lease on this building. And so all the workers that are coming over from Taiwan, they're putting them up in this building to work at their new plant in Phoenix. So it's 100% leased by Taiwan Semiconductor, and they're doing it for the next 2 or 3 years. So guaranteed rental increases from the company and from the property, from a cash flow perspective, and then long-term leases thereafter. And then here's another property in Colorado. It's another multifamily building. Right next door to this one, Blackstone bought I think 500-unit apartment complex and then gutted it and redid it. So the value of this is probably likely to go up. So again, these are like really sophisticated properties and sophisticated companies that are doing these. So I'm a big multifamily guy. I love multifamily. I just think from an investment perspective, again, everyone needs a place to live. It's hard from a construction standpoint and a financing standpoint to build new properties right now. So I think multifamily is a good place to be. Same with self-storage. But again, final thoughts and remarks. Like we basically go through all these illustrations to educate clients on here's what's out there, and then give them ideas as to what might be available for them in their situation. So that's it. And I guess now we can open up to Q&A. Yeah.
We had 1031 exchanges, DSTs, Jeff and Skyler. I know that was a lot of info, so I'm sure it's all brewing. We're gonna open it up for, I don't know.
Start firing
Q&A.
away.
Yeah. We're not gonna
Fire
segment,
away.
just,
Yeah.
any questions?
I've got a two-part question here. Okay, so you mentioned accredited investor. Now, I'm currently trying to become an accredited investor with different programs. Once I do that, now how does that work? Do I have to get reevaluated by particular your company, let's say, to become an accredited investor with your company as well?
Yes, and the reason why is because in the eyes of the SEC and FINRA, we have to know our client. So we have to understand where you're coming from in your financial perspective. If you shared that with somebody else, they know and they have an understanding that you are accredited, but I don't know that, right? And so we're basically the way that that our industry works is kind of like Rain West is the broker, right? And you have agents underneath Rain West. We have what's called a broker dealer. Our broker dealer deals in securities, and we have to hang our license with them. So they're the ones that oversee all of our business activities to make sure that we're doing everything correctly and right. So they're the ones who are verifying your accreditation. It's not me personally, and there are certain ways that they do it. You know, some depending on the type of deal, it'll be something where you have to show your net worth, your total net worth, or your income. There's other deals where they don't necessarily need that, but they like it. So it just depends on the situation and on the deal in particular. But I always say, if you're going to share with somebody else, then everything stays confidential between us and the brokerage firm. But it's something that we have to do.
Okay. And the second part of it is, tell me the difference between this and, let's say, a REIT.
Sure, great question. So a REIT is a traded security, right? You can buy shares on an exchange with cash or whatever that you have. When you buy shares, you own a particular share of that REIT. That REIT doesn't own you don't own the property in the REIT, you just own the shares of the REIT. So from an exchange perspective, it doesn't qualify when you're looking at doing a 1031 exchange because you actually have to hold the property. You can't hold the shares, right? That's the way that the REIT works. The REIT is also, it trades on a net asset value, so it can go up and down in value. These don't have something like that. It's just you hold the property and then you get the cash flow from it, any sort of cash flow that comes from it, and then when they sell it, whatever they sell it for, that's what you get on the end, plus your equity back. And then you can exchange again. There are some deals that are called 721 up REITs. And 721 up REITs are a DST that effectively transition from owning interest in the DST into operating shares of the REIT. And that's after a 2-year period. In the eyes of the IRS, it's Section 721. But what effectively happens is you're exchanging your interest in the DST, which holds the property, into the shares of the REIT. And then after that happens, you can't trade it back. So once you trade into the REIT, you're now locked into the REIT, and you can't do another exchange. You have to sell the shares, and whatever you sell the shares at, you're going to have a tax consequence because that's just the way that the REIT shares work. But what they do is they do it after a 2-year period, maybe a 3-year period, and they exchange it into the REIT. It's called an up REIT, so it's an umbrella partnership REIT, and then you hold that REIT for a year. You have to hold those shares for a year, and then after that, you have long-term capital gains on whatever you sold.
And I promise there's going to be 2 questions. Got another question.
Yeah. Keep it coming.
And that was, I'm surprised there's no, and tell me why there isn't a secondary market as far as the sell on this particular product.
When you're a DST, or when you have a DST, you have to be accredited. So accredited investors, there's not a ton out there, and because of that reason, it's not something that you can market to the general public.
Does that make sense?
Yeah, it does. But even with that spectrum or that population of those accredited investors, I would imagine there would be a buy and sell situation in a situation like that. I'm just kind of curious. Maybe I'm just trying to monetize everything.
Totally understand. In instances where again, like because you can't market these shares on a secondary market, it's hard to find replacement investors for your, for your equity. Especially if you have a lot of equity, right? If you're going to sell $1 million out of a DST, you have to find somebody to replace your $1 million. That's tough. It can be tough. So what the sponsors generally do is, and this is depending on whichever company you're working with, because some don't allow it and some do, but what they'll do is they'll go to their investor base that is in that deal currently, and they'll say, hey, like we have somebody who's coming out of this, they want to come out of it, do you want to pick up any of this interest? And sometimes they'll say, yeah, we do. Other times they'll say, no, we don't. And sometimes the sponsor will take the equity and give the cash back to the investor through a 1031 exchange if they want to do that. Other times they'll just say, we don't have anybody to take your interest right now. You got to stay in here.
It's possible. Like
It's
there's
possible.
folks working on that conundrum. It sort of reminds me in a way of other illiquid real estate. If you have a TIC interest, right, and you own 25% and you're in a 4-person, owned property, it's harder to market that dynamic. There are folks who have worked on a secondary. There are platforms out there if you Google that sort of show some of this, but what he's saying is spot on. It's illiquid, yeah.
Yeah.
Scott,
Yes.
a question we get often is, what happens to your interest if and when you pass away?
Great question. That's a tax question as far as a step up in basis is concerned. But generally speaking, I consider the DST a really cool estate planning tool, an investment. And the reason why is because generally speaking, 90% of someone's net worth, once passed off to the next generation, is blown within the first 2 years. So when you have DST interest, and let's say the DST is like running for 2 or 3 years, the equity's locked up, they can't go blow the money, right? So they get the cash flow while the family's trying to deal with the stuff from an emotional perspective. But I just find that, having that ability to say, your cash is going to be okay for a while if something happens to you. It's not going to be blown. I think that means a lot for clients. But, from a step up in basis perspective, that's a good question for we have a tax person that we work with pretty regularly on the DST side. And I would feel more comfortable having that question be answered by him instead of me because I'm not a tax advisor. Yeah. But typically you get a step up in basis when something happens. Yeah. Yeah.
Yeah, I had another question. Let's say, for example, I had a rental, and just for the argument, let's say my net proceeds, it was $100,000, and I go into a DSTC, and you say they usually go between 5 to 7 years. At the end of those 5 or 7 years, when they decide to sell or whatever, does that trigger a new 1031 exchange that you need to use the services? Or
Correct.
Is that what happens?
Yeah.
Exactly. Yeah, generally what will happen is they'll send you a notice and say, hey, Mr. Client or Mrs. Client, we have a buyer for this property. We're anticipating a close at 45 days or 60 days later from the notice date. And so it kind of gets you thinking, okay, well, what am I going to do next? It gives you some time. When the DST goes, we call it full cycle, the proceeds from the sale will go back to the qualified intermediary that you typically use or that you used before. So it'll go back to Jeff and 1031 specialists. But then at that point, you can decide to do another exchange, or if you want to take the capital gain and just take the cash and run, you could do that. Or again, a combination of whatever you'd like. And this is separate from the REIT conversation, but this is a straight 1031 exchange.
And all the restrictions, timeline.
Same thing.
Applies.
Yep.
Okay.
Same exact timeline. You're doing another 1031 exchange. That's all it is. Yep. Yep.
And a follow-up on that one. So say, for example, I got into one of the DSTs that generates monthly income because, you want. So is there like a vehicle for that where it, sends you a check in the mail?
That's exactly it. Or an ACH, make it easier. So it goes directly in your bank account every month.
So, and then that just, as the tax person, but it would be,
A K1.
It's typically 1099. 1099 because it's not a partnership. Yeah, you can't invest in a partnership. Yeah. Yeah, it's typically 1099s. I have something I can send you to show you like how they typically send it off as far as it's a grantor letter. It's basically a grantor letter, and they say here's what your interests are, here's what you made, and then you can take that and put it on your scheduling just like every other piece of real estate that you have.
So it's not that I'm making a portion of the rental income, it's the investment, the interest on the investment.
Correct.
Okay.
Correct. Yeah.
So it's taxed at interest level.
The other cool thing too that I mentioned is when you're thinking about this from a property perspective, let's say you have an all cash deal or all equity, right? $1 million of all equity. If you buy into a DST that has 50% loan to value, well, now your property value or what you're buying, the property amount of property you're buying is $2 million, right? Because you have 50% equity and 50% debt. Because you're doing that, you have more basis at which to depreciate property, right? Because you're buying more property, so you can depreciate it. And generally speaking, these sponsors, they send out what's called a cost segregation study. The cost segregation is basically, it's like here's what the life, I don't know how would you describe it. It's like here's what the life cycle is like for carpet or windows or.
It gives you the depreciable schedules for,
Yeah,
it breaks off the building versus the add-ons, right?
Yeah.
And you can what
Yes.
you can accelerate, depreciate, and what you can't.
Correct. So they give this to you, this cost segregation study, and effectively what you can do is you can utilize this cost segregation study to effectively shelter a lot of the income that you're getting from the property, especially if you buy more property. So what we find is working with a tax advisor, generally the first probably 3 to 5 years, most of the cash flow is sheltered, which is nice. The problem is you have to continue to do exchanges in order to make sure that you don't get any depreciation recapture. Because when you sell the asset, that depreciation that you took, that accelerated depreciation, you're now having to pay depreciation recapture, which is about 25% of whatever it is that you deducted or that you depreciated. So it can be costly, but that's why you continue doing exchanges. So.
Any other questions?
Cool. All right. Well, we're gonna hang out for about another 15 minutes, mix and mingle. If you want to pick their brain a little bit more, we'll be around. So we have about another 15 minutes. So we have some beer, we have some sandwiches. Please grab some. Take advantage of their brain power. There's brain trust right now. If you have any specific questions or specific case studies you want to go over. Also, just want to remind you, on your chairs and around the room is this little invite for our next seminar, which is going to be about adding value and cash flow to your properties by adding accessory dwelling units or junior accessory dwelling units to your properties. If you're interested, just scan the QR code and register for our next event. Thank you, Skyler. Thank you, Jeff. You guys are amazing. Thank you.